All right. Good morning, everybody. It's a big week. We have FOMC this week. We have OPEX, triple witch. So we're going to be changing out the futures contracts. We have a lot of sentiment changing. We continue to see money moving out of the U.S. at an accelerated rate. The rate of change in the money moving out is what is significant. There is not anything priced in for a cut. From what we can see on the FedWatch tool, they're expecting to hold the line. Now, I've heard some talk about, oh, well, what if they come in and they do a surprise cut? They certainly could, right? We don't want to discount that and say they can't because, well, they can. But markets don't like surprises. And I think if they came in and did a surprise cut, it would spook investors more than help things. Uncertainty is one of the main drivers for why money is leaving the US. They don't want to increase that uncertainty even more by doing surprise things like a surprise cut. So I don't see a surprise on the table simply because of how much it would hurt. That it would hurt that confidence. Mixed bag with what we have going on around the world. Small caps down the most at 0.5%. We can see all four of the US markets in the red, with the NASDAQ basically at zero. The Dow down 0.25%, and then the small caps. Germany was doing a little better. It's kind of faded back now to 0.25%. Excuse me, Japan, not Germany. So we're going to get some housing data, business inventory, retail sales. Look at the forecast versus the previous number. The previous number was in the negative, and they're looking for a positive on US retail sales. That's a big number change. Same thing with retail sales minus autos, from a -4 to a +3. And the survey really negative, which there was some data out last week on the other survey that really showed how politics was pressing this. Doesn't matter, it's just a survey. So, there's always politics involved, and it's always leaning because it is a survey. So, got to take those with a grain of salt. We have some very wide ranges here between what we had and what they're expecting. So, a lot of these, we wouldn't even be looking at them on a week like this when we have FOMC and triple witching. These would not be too big of a deal. But with those wide forecasts, we want to approach with a little bit of caution. We do have auctions today, and we have European Central Bank Christine Lagarde out there chipping teeth. So watch the clock. It's about the best we can say, right? It's just watch the clock. This week, we have the NVIDIA GTC conference, and this is not its first year. It's been doing these conferences for quite a while. The broker Mumu, really wish they'd come up with a different name. They've got a number of articles about this GTC conference. and it's worth checking out if you haven't. You don't even, I'm not logged in, as you can see, and yet I'm looking at Moomoo News. They had this article that talked about previous events and how good we did going back a number of years, from 2017, a 20% move way back then. Wow, that was a game changer. One negative year, and then since then, they've been averaging pretty decent numbers. It's also expected to touch deeper into quantum. I don't know if this is him trying to walk back that shade that he threw on quantum earlier this year when he said it was 10 years out, it's not viable. Basically just told people, don't waste your time. And then everybody went after him for it. And now he's adding it to this. So there's a China AI Day involved in this event, which is today, actually. Then we're going to see end-to-end autonomous driving. That's also today. The keynote address from NVIDIA's CEO is tomorrow. And then we have FOMC on Wednesday, along with robotics on Wednesday, an AI summit on Friday, on the 20th, whatever day that is, and quantum computing on the 20th. Gonna be a busy week. So we've talked about those quantum names before. Kind of keep your eye on them. At the very least, we could see them getting a little more attention. Just, be mindful. They are thin, very thin products. Their options are not very exciting. And that makes it hard to defend your position when the options aren't that good. So NVIDIA could be the thing that we've been looking for. Talked about how we need a catalyst if we're going to try this run back up. So let's just expand this for a moment. If we're going to begin this run back up, this would be a failed flag. Get your 786 line in the sand that we have to get through. If we can get through that, we can challenge 5,900. But what is the catalyst that can give us the fuel to run this move to the upside to even challenge 5,900? Because it won't be price alone by itself. We need some sort of positive economic stimulus to push this up. And that kind of fits into my rant over the last week or so that I've been talking about how we can't expect this administration to use the Fed to promote stimulus and avoid recessions. I don't think they're going to do it. That's what we've been doing for decades. Every time recession is near and things don't look good, the Fed cuts, provide stimulus either just by, talking about liquidity or actually coming in and providing different forms of stimulus. They always come in and play save-a-ho. I don't think they're going to do it. So we need to look for that stimulus to come from other sources, and this is the best thing on the table this quarter. I don't know what else we could have coming, but nothing else has looked this good for a chance to break above that 786 and test the halfback. It's a good start. We do have the change in contracts. You can see I'm on the June series. Maybe that's a little hard to see in the stream, but I am on the June. It auto rolled on Thinkorswim. If you're on a different platform, maybe you haven't rolled yet. You might have to do it manually. Generally speaking, you want to look at the volume and trade the contract with the higher volume. Generally, in the last week before we swap, to the new contracts, everybody goes into the new contract. But we can see that the old contract still has more volume than the new one. So if you just want to get on the one that is auto rolled, it's fine. Otherwise, just watch the volume. And as long as the old contract, the March contract, still has more volume, you can trade it. It's not, quote, unsafe or anything like that. It's just keep your eye on it. Today looks fine. Tomorrow, who knows? Maybe by tomorrow we will all be on the June and nobody will be messing with the March anymore. It messes with things considerably. If you're looking at March, then it looks like we're outside of Friday's range. You can see how right now, if we zoom in, this is Friday, this is where we are, we're inside day. But if we go up and make a bit of an adjustment and we don't adjust for contract changes, well, now we've got an inside day breakout that we rallied up and we opened outside of Friday's range. And on that move down in the overnight hours, all we did was come close to testing Friday's high, and we're still above it, and we're still pressing higher. And that looks completely different than what we were just looking at, right? So it's going to be a little weird all week for people that are not familiar with this. Trade what you have, right? Trade what's in front of you. The intraday price opportunities are still there. We got the put wall 5550, zero gamma, and a volatility trigger way outside of our reach at this point. They're in the 5800s and 5900s. So we're still in deep negative gamma territory, and we're a long way from crossing the divide at this point. And yeah, there's a call wall eventually, way up there, 65.50, long ways off. We can see a market maker move. This is something you're going to see all week. Unfortunately, it's because of the contract change event, and there's just nothing we can do about it. The market maker move is designed to spot out of the money options trading in the front expiration, so the 0-day options. So if they've been carrying options for weeks and weeks and they're now, coming into expiration, they're going to roll them or move them or manage them in some way, and that activity is going to show up in the market maker move. It does not mean that they're hedging at this point, and it's not a helpful tool during OPEX triple witching. So even if they are hedging, we won't see it because it'll be buried inside of all that rolling activity. We could take a full ADR to the downside and we would still be inside Thursday's range. We would just be outside of Friday's range, really close. So a full ADR to the upside, yeah, that would get us a nice breakout on the day and really close to the week. It's not quite Monday's high, but darn close to it. We've been sideways long enough that it started to adjust our ADR levels. All right, the floor pivot this week is a very narrow floor pivot. We don't treat it any different than we would a daily pivot. A narrow floor pivot channel implies that if we break out, it can really run. And that's on the week. So we would be talking about breaking out on the week. Well, to do that, we'd have to get outside of Monday's high of last week, right? So put the chart on a weekly. Look at last week's high. That's what we would be focused on getting a breakout of. $57.50 basically. And if we can get out of that, it says we could really run. Now on the other side of that, it doesn't give us bias on which side would we break out of. So it just says that if we break out, it could grow legs and it could really run on the week. If we look at this on the day, it's a wide channel. A wide channel implies that on a daily breakout, if we try to break out and run, that it doesn't stick and it comes back in again. Just keep in mind that these channels don't make price do anything. It won't make us break out. And if we break out, it won't make us come back in again. It's just giving us some indications on if we do break out, what should we expect? Today's pivot is higher than yesterday's. That's bullish. Price opened above today's pivot. That's bullish. And we've already hit the pivot point. So we don't have an MDP or a missed daily pivot. It's a good thing that we've already hit it. Markets have an 80% chance of hitting the pivot. So when we opened above it, it kind of implied, hey, we got to go down because we got to hit that pivot. Okay, we did that. It held as a structure. We're back above it. Great. While we're here, since it was a narrow week, it's likely that the S&R levels are really close. I know there's a number of strategies that focus on getting to like an R1 for a move into S2 or a move into S1 before going to R2. So it's worth noting when we've had a narrow week like this, how far away are those S&R levels? We would have to get up into 57.20 area just to see that R1. Generally on an FOMC week, I'd be saying, yeah, we're probably going to go sideways Monday and Tuesday, going into hurry up and wait mode. We probably won't go anywhere. I don't think that's true this week. That's why I didn't start the morning briefing with that conversation like I normally would on an FOMC week. I would not expect this market to go into hurry up and wait mode and trend sideways for 3 days while we wait on FOMC. Not this time. There's been plenty of examples throughout history where it's been an FOMC week and we've reached the edge of the entire week's range on Monday. So looking at last week's profile, we can see that we're holding above the point of control of last week. We don't have that in our way. We're struggling with the next area, which was very close to being the point of control. It likely would have, if it had just had a few more minutes of time, it would have brought that up. And at the moment, we're holding above it, but consider that one more of a zone, and we're fighting it right now. So we got to get out of this zone. On Friday, we tried to get through the top. We can see this big wick up here. It was rejected. And if we zoom out a little bit, we had another big wick here. Lots of defense. When we tried to run up, get through that 5,700, we took a smackdown. And then this time we didn't even get into it and they smacked it back down. So those sellers are bringing it down lower, are defending sooner, front running that 5,700 on this last attempt. We don't know if we've absorbed all of that up there or not, or if they've continued to move their structure lower. We'll find out if we don't make it to 5,700 again. 10-day, 30-minute volume profile with TPO, it's here with us. So like a zone or a range, we can cross back and forth through this thing as much as we want. It's not going to be supportive or resistive until we leave the range and then come back to it. So as long as we're holding around it, we can use this as a springboard or a starting point for a move up. But 58.50 is where we left a lot of footprints behind. It's going to be hard to get through that level. We're going to be getting into the new contracts, and as you can see, that's messing up where the lines and the levels are at. We had a VPOC from Friday, but it looks like we've already hit it. So at this point, it would not be a VPOC. It would just be a point of control. And the textbooks tell you to carry forward that point of control. I don't generally do that because I've already got enough contracts, enough pivot points that I don't need more. But if you want another pivot point, that is a valid pivot point worth carrying forward. I'm just adjusting this a little bit because it's not a VPOC anymore. It has been hit. It's just a point of control at this point. So it is a level of concern. We are above it now. We kind of want to keep it. Since we've crossed through that level, it doesn't have the same considerations as one of these other ones that is a VPOC, but still it's likely to have a lot of weight. And when we get into regular trading hours, it's likely that if we test it again, we'll see a response there as well, because there are different funds and firms with different restrictions and time frames, and hitting it in the pre-market is not the same as hitting it in the regular trading session. So 56.78, it's a point of control. There's been a lot of FOMC events over the years, so it gives us something to study. We can mark those dates on a chart and go back and look and ask, well, how did that Monday and Tuesday go before the FOMC event? Here was one of those where we gapped down from Friday's close to Monday's open, rallied to close at the high of day Monday, rallied to close at the high of day Tuesday, got into FOMC on Wednesday, where we had an even bigger push completely outside the range on the week. So as I had mentioned, just because it's an FOMC week, don't believe that it has to go sideways on Monday and Tuesday, because there's plenty of examples where that didn't happen. Here's a Friday where we closed. On Monday, we broke out of Friday's high and we ran all the way to close at the high of day. Now, granted, the next day on Tuesday, we went sideways, then we gapped down FOMC and things got pretty nasty. But it just kind of validates the point, right? That it can be a sideways event while we wait for the data, but it doesn't have to. And I don't think it's going to be this time. So last week, we were looking at the range for the new week. And the idea was that it didn't look very much different than the week that we had. But on Friday, it wasn't set yet. So now we can compare the week we're on to the week we had And we can see that last week was a bigger week than this week. Now, these ranges are derived by a math formula with two pieces of information. One is time, and the other is volatility. Well, we have 5 days this week. We had 5 days last week. It's not short weeks for holidays or anything like that. So time is the same in both of these. The only difference is volatility. The greater the volatility, the wider the range will be. You can see that this week has a narrower range than last week. That is not because there's no threat. FOMC and events like FOMC are volatility suppressing events. I know the first time somebody said that, I thought, man, you're cracked in the head. Bro, have you ever seen price move on FOMC day? It's a big move. Why would you say that it's volatility suppressing? And that phrase is because before we get FOMC, a lot of times we just go sideways on Monday and Tuesday. That is a perfect representation of suppressed volatility. So sure, when we get FOMC, we get big moves. But before we get FOMC, a lot of times we go sideways. This is implying that the market believes we're going to go sideways for a couple days into FOMC. So if we don't, it's going to surprise a lot of people. It's going to surprise the money that was being priced in here that said, oh, we're probably going to go sideways for 2 days. They're off sides. We are more than 4% below the 10-week. Still looking for the move back in the other direction. We've reached an extreme at this point that if we go any farther, it will look like the bear market of 2022. So we are expecting a pause here and or a mean reversion back the other way. We're looking for a correction. But a correction from this sort of move can be a correction in time, or it can be a correction in price. So a correction in time would mean we're just going to hold the line and go sideways. And that gives the 10 time to catch up to us on its own. A correction in price would be a sharp move back to the upside to move towards the 10 quickly. If we look at the distance we are from the 10-day, we already started that correction last week. On Friday, we jumped above the 4-period daily moving average and we closed at the high of day. We didn't get back inside the box, but we gave it a good run. And we closed solidly above that 4-period moving average is the first step. We are less than 1% away from the 10-day. That's the target right now. Get to the 10-day, get above it. And if we get above it, then it's likely we can get 0.5% above it. That would put us back into this previous zone or range back here. That'd be a good start. Less than 1%. If we zoom out and look at things over the last 5 days, we can see a little bit of a capital rotation. The top 3 charts here are risk on. We would expect those to do good in a positive economic backdrop. And the 3 on the bottom are risk off. It's a flight to safety. It's a capital rotation that we would expect to see if people believe the economy is slowing and things are going to get rough. Now, this grid was built years ago before AI data centers started to corrupt the XLU, which is now more and more tied to data and AI and communications, and it just really doesn't fit down here in the defensive technology area, defensive group. So it's positive along with energy, which ties right back in with that, and then technology and financials. But we don't have consumer discretionary, which is a really big part of the Mag 7 play. So it's a broken rotation. It's an odd one. It's a little different than what we're used to. And it shows that it's not done by any means. We're scattered all over the place with consumer discretionary down and tech and staples down. But staples is down a lot more than consumer discretionary. So when we look at growth versus value, it doesn't necessarily mean that one's going up and the other's going down. They can both be going up. They can both be going down. We'd be gauging which one is going down less or which one is going up more in the growth versus value concept. And right now, growth is doing better than value if we're looking at those two metrics, but they're both down. Growth is just down less. So this morning, Bitcoin is down and the banks are down. That's our benchmark of 0.5%. Anything that is not down at least 0.5%, it's moving in the direction. Biotechnology is working its way down there. It's not quite there. Looking at what's up this morning, nat gas, which is that's kind of a joke. It's not going to help. Gold miners are almost there, not quite to 0.5%, but they're working on it. We got the Mag 7 and chips and bonds moving in the right direction. They're just not enough. Need to move farther. So we're looking for the trigger this morning. It's going to push chips and Mag 7 and tech and Bitcoin, precious metals, which, precious metals, it's got a history with FOMC where it tends to be positive or bullish into FOMC, gold, silver. It's weird like that. All right, you do not want a rally day based on nat gas and solar. That's just unsustainable. So if we're going to get a breakout rally day, we need to see chips, communications, consumer discretionary, technology, and we don't have it. So watch for the Mag 7 early before we get into the open. And then once we are in the open, continue to watch those, but add to that options flows, because that can be another driver that can get us to break out. Yeah, we got nothing. So it's simple enough at this point. GTFO yesterday's range, look for the flow to come in to continue the push if we do get the breakout. You can use just very basic moving averages on the daily. Aim for the 10-day 57.32 cog line. Above that, aim for the 20-day, which is really close to 58.50. So you'd have 57.32 and then 57.50, 57.92 cog line, get into 5800, 58.11 cog line, 58.32, and then 58.50. That may seem like a long ways off, 58.50 being, way up here near the zero gamma line. But in the current market environment, some of the biggest days to the upside happened in a negative market environment. And that's where we're at, is in a negative market environment. We're below the zero gamma line. We can easily get a sustained drive to the upside. Just keep in mind, it doesn't owe us anything, right? It doesn't owe us a move up. That's just what everybody's expecting because, well, we've already fallen a long ways. Generally, a market that has fallen this far is going to mean revert back the other direction to some degree. But it doesn't have to. And now that it has stabilized like it has, these 3 days of going sideways, it can just leg down and continue to go lower. It does not owe us a move back to the upside. If we get through that 57.22, that's the 786. And that gives us a chance for 5,900, right? Because this is the bear flag. And bear flags continue to the downside. So we're looking for a failed bear flag, breaking that 786, making a run up. And what that eventually gives us, if we get a failed bear flag, is the start of a cup. The start of a cup, because we could get to this halfway point and reject there and come back down again. We don't know. Let's just get past that 786 first. That's what I got for you guys. Be careful, be safe. Watch